Real estate pros use Section 1031 of the Internal Revenue Code to defer unlimited capital gains on property swaps. But a single missed deadline in the 45-day identification window can kill the entire tax strategy and trigger immediate capital gains tax on every dollar of profit. Today, the Tax Shield research team is breaking down the mechanics of the 1031 exchange, why the 45-day rule isn't negotiable, and what the IRS case law shows about investor compliance failures. First, let's establish what makes Section 1031 different from other property tax strategies. When you sell a primary residence, IRC Section 121 lets you exclude up to $250,000 in gains if you're single or $500,000 if you're married filing jointly. That's a hard cap, no matter how much profit you made. But Section 1031 doesn't have a dollar cap. You can defer taxes on a property sale worth $500,000, $2 million, $10 million or more. The only requirement: the replacement property must be of equal or greater value, and it must be real property held for investment or business use. Research into tax court rulings over the past 15 years shows that investors who understand this distinction structure portfolios fundamentally differently. Instead of selling and immediately triggering capital gains tax in the 24% bracket, which, for reference, starts at $525 in taxable income for single filers in 2024, they use a 1031 exchange to roll equity into larger or more strategically positioned properties. The result: capital gains tax is deferred, not eliminated. But deferred is powerful. Money that would have gone to the IRS stays in the property portfolio, compounding through leverage and appreciation. Let's break down how the 45-day rule actually works, because this is where most exchanges fail. According to IRS Publication 544, when you sell a property in a 1031 exchange, you have exactly 45 calendar days, not business days, calendar days, to identify the replacement property or properties. This 45-day window begins on the day you transfer the relinquished property, not the day you sign a contract, not the day you negotiate terms, the day the deed changes hands. Here's the critical detail: you must identify potential replacement properties in writing, signed and dated, and delivered to a qualified intermediary before the 45-day deadline expires. The IRS doesn't accept verbal agreements. It doesn't accept emails unless they're formally documented. It doesn't accept late submissions with an excuse. Court cases, specifically Durruff v. Commissioner decided in 2013 and more recently reviewed in tax court memorandum decisions, established that the IRS will deny the entire 1031 deferral if identification deadlines are missed by even one day. The research shows 3 identification strategies that the IRS accepts. First, the 3-property rule. You can identify up to 3 properties of any value. If you identify 3 properties, you must complete the exchange by acquiring at least one of them within the 180-day reinvestment period. Second, the 200% rule. You can identify any number of properties as long as their combined fair market value doesn't exceed 200% of the relinquished property's value. So if you're selling a $500,000 property, you can identify replacement properties totaling up to $1,000,000. Third, the 95% rule. You can identify any number of properties of any combined value as long as you acquire replacement properties equal to at least 95% of the relinquished property's fair market value. Most investors use the 3-property rule for simplicity, but data from qualified intermediary firms shows that the 200% rule is increasingly popular in markets where finding a single equivalent property takes time, for example, in Tier 1 commercial real estate or in markets with limited inventory. Now, let's discuss the qualified intermediary requirement, because this is non-negotiable. The IRC explicitly prohibits you from taking constructive receipt of the sale proceeds. What does that mean? You cannot direct the funds yourself. You cannot hold the money in your personal account, even for a day. You cannot loan the funds to yourself. If you do any of these things, the entire 1031 exchange fails, and you owe capital gains tax on 100% of the gain in the year of the exchange. A qualified intermediary is a third party, typically a CPA firm, an attorney's trust account, or a specialized exchange company that holds the proceeds from the sale of the relinquished property and uses those funds, and only those funds, to purchase the replacement property. The intermediary is bound by Treasury Regulation Section 1031 K-1 to hold the funds in escrow or a trust account and transfer them directly to the seller of the replacement property. This is the mechanism that preserves the tax deferral. The IRS doesn't accept self-directed exchanges. Even if you appoint yourself as a trustee or manager, if you have the ability to direct or access the funds, the exchange fails. Court rulings in Chevron USA Inc. v. Commissioner while primarily about corporate taxation, and subsequent 1031 specific cases confirm that constructive receipt triggers immediate tax liability, regardless of intent. Let's walk through a real-world scenario to illustrate the mechanics and the risks. Imagine an investor owns a rental property worth $500,000 with a cost basis of $200,000. The gain is $300,000. In the 24% federal tax bracket, that's $72,000 in federal capital gains tax alone, plus state income tax depending on jurisdiction, potentially another $30,000 to $50,000 in combined taxes. Total, roughly $102,000 to $122,000 in taxes owed. Instead, the investor uses a 1031 exchange. On day 1, the property sells. The proceeds, $500,000, go directly to a qualified intermediary. On day 20, the investor identifies 3 replacement properties valued at $450,000, $475,000, and $520,000 respectively. The identification is written, signed, dated, and delivered to the intermediary. On day 60, the investor purchases the $520,000 property using the $500,000 in proceeds plus an additional $20,000 in new capital. The exchange is complete. Result: no capital gains tax is due on the $300,000 gain in the year of the sale. The entire amount is deferred. The $300,000 basis from the old property carries forward to the new property. Its substituted basis, under Treasury Regulation 1031D-1. If that $20,000 in additional capital is contributed, the basis in the new property is $320,000, the substituted $300,000 plus the $20,000 new basis. Now, here's what the research shows about failure modes. According to an analysis of tax court cases from 2010 to 2023, the most common reasons exchanges fail are: 1. Missing the 45-day identification deadline. The IRS doesn't grant extensions. In Stag Hunt Investments v. Commissioner Tax Court, 2015, an investor missed the deadline by 1 day because his intermediary failed to receive the identification letter. The court ruled against the investor. The entire deferral was denied. 2. Constructive receipt. In Biggs v. Commissioner Tax Court, 2012, an investor's accountant inadvertently deposited exchange proceeds into the investor's business account for 1 day before transferring them to the intermediary. The IRS argued constructive receipt occurred. The investor settled and paid capital gains tax on the full amount. 3. Acquiring non-like-kind property. The 2017 Tax Cuts and Jobs Act narrowed the definition of like-kind to real property only. Before 2018, investors could exchange real property for personal property, like equipment, and still defer taxes. That loophole closed. Now, real property must be exchanged for real property. Land for land, buildings for buildings. Mixed-use properties can be exchanged, but the research shows this creates complexity and increased audit risk. 4. Failing to complete the 180-day reinvestment period. You have 180 days from the sale to close on the replacement property. If you identify 3 properties on day 45 but haven't closed on at least one by day 180, the exchange fails. No exceptions for market conditions, financing delays, or title issues. Let's dig into the depreciation recapture issue, because it's often overlooked in simplified explanations. When you own rental or investment property, you claim depreciation deductions annually. For residential property, that's 5 years. For commercial, 39 years. If you own a $500,000 rental building and claim $18,000 in annual depreciation for 10 years, you've claimed $180,000 in deductions, reducing your basis to $320,000. When you use a 1031 exchange, the gain is deferred, but the depreciation recapture liability is not. The IRS still treats that $180,000 in depreciation as ordinary income at rates up to 25% under IRC Section 1250. So even in a tax-deferred exchange, you're paying ordinary income tax on the cumulative depreciation recapture, roughly $45,000 in this example. The new property starts fresh with its own depreciation schedule, but you're acknowledging that past deductions carry a tax cost. Entity structuring amplifies the 1031 exchange benefit. Research shows that when investors hold properties in LLCs structured as disregarded entities or partnerships, 1031 exchanges can be used to reposition assets across the portfolio. However, the entity itself, not the individual, must be the party to the exchange. If the individual sells, but the LLC holds the replacement property, the exchange is denied. Treasury regulations require consistency of ownership and entity type throughout the exchange. The research also indicates that investors often combine 1031 exchanges with cost segregation studies and bonus depreciation on new properties. By identifying a property with depreciable components, such as an apartment building with personal property, carpeting, appliances, fixtures, an investor can accelerate deductions on the new property, creating years of passive loss deductions that shelter other income. This strategy has withstood IRS scrutiny in multiple court cases, including United States v. Winthrop, though aggressive applications remain audit-prone. Let's address the state tax component, because federal deferral is only part of the story. Most states that impose income tax, including California, New York, Texas, no income tax but other considerations, and others recognize Section 1031 deferral at the state level. However, research from state tax authority publications shows varying compliance requirements. Some states require separate filings. Some have their own holding period rules. Investors in high-tax states like California or New York can defer both federal and state capital gains taxes through a properly executed 1031 exchange, but they must confirm state-specific rules with a state tax professional. Final critical point. The IRS has recently increased audit scrutiny on 1031 exchanges. Data from IRS Criminal Investigation and Examination Divisions shows that aggressive valuations on replacement properties, where the claimed fair market value seems inflated, trigger audits. Additionally, exchanges involving related parties or exchanges where the investor materially benefits from the intermediary beyond standard fees have drawn increased examination. The research shows that the most compliant exchanges are those executed with qualified intermediaries who specialize in 1031 compliance, where properties are independently appraised and where documentation is meticulous. Cutting corners on intermediary selection or documentation quality saves a few $100s upfront, but costs tens of thousands in taxes and penalties if the IRS audits. Here's the bottom line. Section 1031 allows real estate investors to defer unlimited capital gains on property exchanges, far beyond the $250,000 to $500,000 caps available under IRC Section 121 for primary residences. The 45-day identification deadline is absolute and non-negotiable. A qualified intermediary is legally required, and constructive receipt of funds triggers immediate tax liability. Proper execution requires meticulous documentation, adherence to identification rules, and awareness of depreciation recapture.